Hi, and welcome to my YouTube channel, Fin, Band, Tax and Biz. From financial dependence to financial independence. Today we are here to talk about the different bank rates adopted by RBI. RBI plays a crucial role in managing India's monetary policy. One of the key tools are bank rates, which influence the cost of credit and availability of funds in the economy. Overview of RBI's role in monetary policy. Price stability. RBI aims to control inflation and maintain stability in economy. Further, it also ensures economic growth. RBI action also aims to foster economic growth by influencing credit availability and investments. Financial stability. RBI ensures the stability and smooth functioning of financial system. Key bank rates set by RBI. CRR, also called the cash reserve ratio. SLR, the statutory liquidity ratio. Repo rate and the reverse repo rate. Let's go through all the four rates in detail. Cash reserve ratio, or the CRR. Banks have to keep a certain minimum percentage of total deposits. Total deposits includes demand deposits and time deposits. So banks have to keep a minimum percentage of total deposits with RBI in form of cash. This is called cash reserve ratio. An increase in CRR makes it mandatory for banks to hold large portion of deposits with RBI and hence reduces deposits available for credit lending, profitability and money supply. Main objective of RBI is to avoid any kind of shortage of money in meeting the demands of depositors. At present, the CRR is fixed by RBI at 4.5%. Now, let's say the impact of the CRR. Higher the CRR, banks will have less money available for lending. Hence, it will reduce the liquidity. That is, money circulation in the market would be reduced, thereby slowing down the economic activities. And inflation would be reduced. Reducing lending helps control inflation by limiting the money supply. Now, let's understand this concept with an example. For example, if bank has a deposit of rupees 1,000 and RBI has fixed the CRR rate at 3%, banks have to deposit rupees 30 with RBI and balance 970 rupees would be available with the bank for lending to the general public. So, in this process, RBI has actually reduced the amount available with the bank, thereby curtailing the circulation of money in the market. The next ratio is your statutory liquidity ratio, or also called the SLR. All banks are required to maintain a minimum percentage of total deposits as liquid assets in form of cash, gold, and other securities besides CRR. This is called statutory liquidity ratio. Change in SLR has the same impact as a change in CRR. In India, banks have been increasing the SLR rates from 25% in 1970 to 38.5 in 1990. This has been reduced to 30% in 1992. At present, the SLR rate is 18% for commercial bank. This means if the bank has a deposit of rupees 1,000 and maintains a CRR of 20% and SLR of 6%, bank has to deposit rupees 260 to RBI and rupees 740 would be available with the bank for lending to public. Now, what is the impact of the statutory liquidity ratio? Higher the SLR, banks are required to invest a larger portion of deposit in government security. This will ensure that less money is available for lending in the hands of bank for businesses and individuals. And increased investment in government securities will help finance government lending. So hence government, it would be a supportive move for the government. Next is your repo rate. RBI allows temporary loan facility to commercial banks as against government securities on a condition that the bank will repurchase securities within the short period. Central bank lends money to commercial bank in view of shortfall of funds. While dealing with repo rate, collateral is required to be provided. So, collateral is mandatory in case of repo rate. So, let's go through the significance of repo rate. Lower the repo rate encourages banks to borrow more money from RBI at a lower cost. Increased lending. Banks lend more money to businesses and individuals at lower rates. Economic growth. Lower borrowing costs will stimulate investment and boost economic activities. Reverse repo rate. This is the rate at which RBI pays to the bank in order to keep additional funds, which is reverse repo rate. It is a rate at which banks park surplus funds to RBI. It is done when there is an excess liquidity in the market. At present, the reverse repo rate is 3.35%. Reverse repo rate is always less than the repo rate. Now, let's discuss this purpose of the reverse repo rate. Lower the reverse repo rate, banks are less incentivized to lend money to RBI. Increase lending to economy. Bank prefers lending to businesses and individuals at market rate. Increased liquidity in the market. More money is available for lending would boost the economic activities. Bank rate. Bank rate is a rate at which RBI lends to commercial bank. It is a rate. An increase in bank rate would result in increase in other market rates. When central bank finds that the inflation is increasing, RBI will increase the bank rate. Hence, commercial banks will borrow less money and inflation would be controlled. For example, RBI lends to bank at 10%. All the domestic banks have to lend at a rate which is higher than 10%. That is, which is higher than the bank rate. How changes in bank rate affects the economy? Let's look at two scenarios. One is when there is an increase in interest rate and when there is a reduction in interest rate. When there is an increase in interest rate, the borrowing cost would be higher, thereby resulting in reduced lending and slower economic growth. Whereas in case of a decreased interest rate, the borrowing cost would be lower. There will be an increase in lending and potentially higher inflation. Conclusions and key takeaways. RBI bank rate policies are essential for maintaining the economic stability and controlling inflation. By influencing interest rate and liquidity, RBI plays a crucial role in shaping the Indian economy. Thank you for your patience hearing. Do like and subscribe to my channel if you find the video informative. Don't forget to hit the bell icon to get instant notification of my new videos. Thank you and happy Diwali to all of you.